So first thing I definitely want to talk about is risk management, right? Um, when we're working with prop firms or cash accounts, we want to completely be in control of our risk. We lose that ability when we over leverage a trade. And if you need an example of what over leveraging looks like, go to a sim account or a paper account, and in your trading panel, if you use TradingView, this is an easy way to do it, right? And I'm going to show you the ramifications of it. So if you go connect to your trading account and you open that trading account settings, right? You can go in here and set your risk. I just got to figure out where it's at. Maybe they don't let you do it anymore. Or I'm looking under the wrong one. Settings, here we go. Okay. So under our account settings, which is the gear icon here next to your profile, right? We can open this leverage, right? And we can adjust what we can trade, how much we can risk on fake accounts, paper accounts, if you want to call it that way, okay? By default, you are set 1-to-1 or 500-to-1 on futures. On futures, we want a 10-to-1 ratio, okay? So what that does, and if we reset our account, it deletes your balance and everything you've done, right? And gives you this screen. And so what we're gonna do is change this number to 2,500 bucks. Okay? Y'all see how I did that? And if you have 150K, you set it to 3,000 and then just hit reset. Now you have a $2,500 account balance. Okay? This is how you test your ability to psychologically manage an account appropriately. So if we look at that and we go, let's go out to a 5-minute just for a minute here and look at a trade. So we go look at a trade here. Well, look, we just hit support down here. We're bouncing up. I want to take a trade, right? So if I go in and full port this account and I buy 7 contracts, right? What's it say right here? Not enough funds to complete the order. Required margin exceeds your available funds. That's your first red flag. You're over leveraged, right? So now let's open our trading panel. And let's change our contract number down to 1. And let's see if it'll let us buy. Here we go. Now this is 1 mini, okay? So if I get my trade wrong and I give it from my entry 905 to 915, 10 points, which is very tight stop loss on NQ. You're risking $200 and you just lost. So let's try it again. Let's say price is going to come down and retest a low here, or the most recent support. So now I want to be a buyer here. Just looking at these few candles, right? And we're not worried about being right or wrong here. We're talking about psychological risk management. And what I see a lot of traders do is they'll see, oh, I think it's coming here, and then the candle starts running the other way, Psychologically, this is going to trigger you to do exactly this. It's going to make you want to push your trade up to the price. It is the single-handedly worst thing you can do, right? Set your order and let the price come to you, or wait till the price gets to where you want to be in and then put your order in. That is a big part of being a disciplined trader. Doing what I just did to push into this order is what you don't want to do. The chart is always going to tell you, just by looking at the candles, where the price is going to go. And all you got to do is look at where price has been, right? Price was here. Price came down here, retested it. Price could not close below this level. So that's a pretty safe level. The closer you get to, the better of an entry you're going to have to trade in the opposite direction. And that works same at the top, right? Price has already been up here, but it was a while ago, right? See how the price was up here, back here, back on the 7th of January. Okay, so we already know price has been here, price went back, price failed. Added commentary by my peanut gallery. So this is what we look for, right? We look at repetition, we look at support, and we look at resistance. So when price came back this time to test where price failed here, we created a small pullback so that we can continue to go up and test the price action that got rejected here. Okay? So when you hear anybody in the trading community reference to the statement of look left, this is what we intend for you to see. We want you to look left because you're looking at prior rejection and prior support. Okay? Anybody have any questions on that?
No, sir.
Okay. Morty, welcome in. You do have you're sharing your live video if you weren't aware, but that's okay. We don't mind seeing what you look like. Just don't want you to show anything unexpectedly or unknowingly. Somebody's got some feedback going on.
No, we just got Lana's account in here too. She's the duck, so
Gotcha.
we can both see the screen in here.
Okay. I got some. Thank you, though. So we can see we've been in this trade for a while, right? And we haven't really gone anywhere. Now, what I expect is price to go up. Can anybody tell me just by looking at this where the first point, if I expect this trade to play out to the upside, can anybody see where the first problem would be if I'm trying to continue higher?
I like that level next to that big God candle actually, where it kind of flattens out a little bit.
Yep. Good. So
A little bit below the 38.
your eyes are naturally starting to see the shelf of support and resistance, right? So if I put a line right here, so look, this confirms itself, right? Because we get a bunch of price that pushes up to it and then can't get through it. So it comes back down, gets more orders, right? Fills the imbalance left in the market here by this big impulsive buy candle, and then it continues up. Tries again, can't quite get there. Well, then it comes down and gets more orders out of this impulse candle, finally pokes through and probes the level. This right here tells you price is going to come back and grab all of the impulse buyers here so that it can blow through, right? So when it blows through with force to convert this prior resistance to current support, you are going to get a retest. This is what a retest looks like. This is what a failed retest looks like. But your job isn't to enter here. Your job is to enter on this retest. And your stop loss needs to be very, very minimal. Okay? Because if that retest, if that candle doesn't open and go your direction immediately, it only has two other options. It's going to go sideways or it's going to fail. Okay? And this is what happens when you see a failure. And this God candle is a perfect example of a break of support. This candle is a great representation of a retest of support. This candle opens and continues in the direction we intend to trade, right? So this is a great example of a break, a retest, and a trade you could have taken. Now this isn't a very big trade because it's thin market volume in Asia. But if you're not near a strong level of support such as this right here, this trade will continue down and set lower lows and higher lows. Okay? And they are going to retest the prior controlling low. Just as when we are going up, we retest the prior controlling high. And I'll break that down more visually as we move forward here. Now, you guys see how our entry's at 903.50, price is at 902.25, right? We're already negative $45. Okay. How many losses at $45 or $50 can you afford before you lose $3,000? Quite a bit, right?
Like 60.
Right. Now that's based on 10 micro contracts or one mini, right? So multiply that number for every mini contract you trade. So if you were trading 3 contracts right now, you'd be down almost $400. Do you see how quick over leveraging can destroy your account?
Mm-hmm.
That is the benefit of the knowledge that I am putting down here right now. The key takeaway is do not over leverage. You do not have a big enough account size to do so. Okay? And keep this in mind.
Attention.
The top 1% of traders, the guys that prop firms copy their trades from, never risk more than 0.5% of their account. And if that's a new eval, that's about $12.50 a trade that they risk. Anybody have any questions?
No, sir.
Okay.
How much stop would you put on that retest entry?
So on that retest entry, if your level is here at 926, your stop would need to be above the highest wick here, which would put you at 943. So if you're not over leveraged, right, on one micro contract, that would be about $40 roughly, if that. So when you take a trade like that, you have to make a decision. Do I want an open border risk tolerance or do I want a confirmation risk tolerance? I personally like to run confirmation risk tolerance. And what I mean by that is that if I take a retest trade, I have a set parameter where it invalidates my trade. And I would do that here if price broke this level here, because I do not want price to engulf either this base candle or overtake this bearish candle, right? Because that is a pretty good sign of strength. So in this instance, I would place 4 points of stop. I would target the bottom of this low here, meaning when this candle opened and started pushing to the downside, which it pushed up first and then started falling. As soon as it could not break this wick or at the close of that candle, I would have entered that trade short. Somewhere near the close. Okay? And that would have garnered you 914 to roughly, let's call it 20 points. You don't need very many 20-point trades on NQ, properly leveraged, to be highly successful and profitable. Make sense? Okay. Now, anybody notice a pattern here in price as it's going down?
And shoulder?
No.
Or
No, I mean just more what price is actually doing, right? So we had a drop down to here, right?
mm-hmm.
And that gives us a resistance level, right? Because look, price broke support right under these candles here, right? Price reacted here. Price broke through. What did price do with this doji candle? It retested that support, right? The retest held, price fell. Do you see that? Now look, okay, price came down. So we broke the support, we came down. And at Asia Open, we came back up, and what did we do here? That is your primary retest, correct, right? This was Friday's retest. This is market confirming 965-ish area as a ceiling, right? So price came down, right? And now what did price do? Price came back up. Anybody see where it retested? Right here. Do you see that? Do you see how it retested the bottom of that flatting, that shelf where price broke down to, right? So now once price has successfully retested that, it can aim for its first place, which is going to be the bottom that it originally set. That is now your current level of support until it's proved otherwise. So if we're in a downtrend for the rest of Asia, or any market, period, this applies to any time that you're trading. If you continue to see the kind of behavior where price goes and establishes a lower low below this low, right, and a lower high below this high, price will always come back up and retest that controlling low before it continues in the direction it's ultimately going. Anybody see the habit here? Price went down, price came up, retested over here. Price went down, price came up, retested over here. Price will come down and retest this level right over here as it continues to go down until we print price action or we get into a discount area where buying is more attractive than selling. Anybody have any questions on that?
What does price action mean?
So price action is the argument between buyers and sellers, okay? And that's where candles will tell you what the result of that let's call it an auction, right? And so price action is identified by behavior. And the typical behaviors are setting either lower lows and lower highs, or higher lows and lower highs, or higher highs and higher lows. Okay? Price action also, when it trades in a range and creates equal highs and equal lows, is considered consolidation. Okay? So think about it in terms more like time and distance, right?
Yeah.
Time means price spends an extended amount of time, right, in a range that doesn't really go anywhere. You go from the top to the bottom, and you continue to do that for minutes, hours, days, weeks, whatever situation you're in, right? And so when we trade time, we lose money, right? So trading this box here would be trading time, right? And so if I take this box, fix this box, there we go. So if we box these candles right here, right, and we started trading long here, price comes back and we didn't win anything, right? We trade long, price comes back, we didn't win anything, right? This is what I mean by your trading time. Price action is telling you that there's no winners between buyers and sellers. You are just arguing between support and resistance. So winners clearly win when you break out and price moves in distance or expands, right? So it's when price moves in expansion is where we want to trade, because if we took a long position from the bottom, guess what? Price did not come back to where we started.
I see.
Okay? So price action is just a continuous ability to read two things. The trend of the price action, meaning is the price of the asset going up or is it going down, right? And price action will also tell you where you're going to most likely test your support and resistance. Okay?
Thank you.
And there's more to it, but that's the easiest explanation that I can give you that's not going to over paralyze you with the amount of information involved with price action, right?
Got it.
Because there's a lot more I could layer onto that about leaving wicks, the length of the wicks, the kind of candles, right? These are all things that you have to learn in layers, because if you learned it all at once, it would be overwhelming and you would be highly confused by it.
Yeah.
And I can't even really say highly confused by it. I'm just saying it would be like information paralysis. You know too much without actually knowing where to apply it properly. So we can see we haven't been in this trade for more than 15 minutes and we've already lost $760. So we're going to circle back, right, to why over leveraging and risk management is crucial, right? So the bigger size position you take, the more you lose, the faster you lose it. And this goes back to my next lesson, right? If you take a trade as a new trader and you can count to 5 and it is not going in your direction, cut the trade and reevaluate your entry. You either missed a break and retest, or you forced a trade that should have been otherwise avoided. And I want everybody, new and not, to get this through your head, okay? No trade is better than a bad trade, right? Make that your mantra. No trade is better than a bad trade. If you have to generically engineer something or view something different to justify taking a trade, that is not a trade you should take. I have 3 basic requirements on why I take a trade, right? And it's 3 questions. Why am I taking this trade? Where should this trade go? And where shouldn't this trade not go? And if I can't answer one of those 3 basic questions, I do not take a trade. Make sense?
Yep.
Okay. So we're going to go ahead and push this down, and we're going to try and cut it here. Now, I could have taken that trade probably out at break even, but I don't want you guys to see, you know, bad habits, right? Because I ultimately know price will return to this level to retest it. But the reason I won't allow that to happen is because that trade could push down more than I have for equity in my prop account, right? So it could go below my account and then ultimately come back to where I knew it would. So this is why I say, when you take an entry, count to 5. If it is not running in your direction, exit. Get as close to break even or as small of a loss as you can. But reevaluate your entry and look for a better position if you still see confluence to validate that trade. So a few things I look at when I get a trade that loses is I look at what did I miss on the chart. Did I miss a level of support? Such as, did I miss the top of these candles or the bottom of these candles, right? When we have to think about support and resistance, everybody thinks it's a hard line in the sand, and that is absolutely false. Your support and resistance can exist in a zone like this, okay? Where we clearly identify a line in the sand, we can clearly identify a zone. And look at what happens to price when it gets near that zone. It starts trying to move away from it. Do we see that? Anybody have any questions about that? This is not an automatic guarantee for an entry. This does not mean price is going to continue up or down. This is just showing you that there is an area that price is reacting to. And if you want to see why, you have to look left and you have to identify there was prior price below, prior price above, and prior price in. So to me, that says there's a zone here, not a hard line in the sand. Okay? And then as you get more advanced in your journey, you're going to get taught to look for what people call fair value gaps and inversions and all that fancy stuff. Try not to get too caught up in it, right? Just try and understand it as the market creates imbalances that must be rectified before it can continue in any one direction. And it doesn't mean it's going to be rectified in that minute, in that day, or even in that week, right? We have imbalances that were created in 2008, 1999, 2006, 2012. Those imbalances will eventually need to get corrected, right? But let's just hope we're not around for any of that. those are like apocalyptic, like market crash levels, which, just looking at history, is a distinct possibility one day, right? It is inevitably impossible for it not to happen. Statistically improbable, but not impossible. Just remember that.
Understood.
So now we've talked about downside and how price will always come back up and retest your controlling low, right? Price is going to come up and retest your controlling low. And you heard me just touch base on zones, right? So if this level right here at the 889.75 does not stop price, does that mean it's an invalid retest? Anybody got an answer? No? Alright. The answer is no. That does not invalidate the retest. Because again, we have to treat this entire area as resistance, right? this whole candle sets our entire range of resistance. So price can push anywhere into this box as long as it does not close above these candle wicks, it is effectively resistance. So this is what we use to confirm. If we get a candle body close above that level, okay, if we get candle body that closes above this shelf, that is a reversal. You are going to go retest the bottom of these candles. If you close above the top of these candles, you are going to continue going and doing that same cycle all the way up, continuing an expansion based on a reversion or a reversal. Everybody understand that?
Hmm.
So always keep in mind, if you're trying to look at an entry short and you get a candle body close above your rejection or resistance, you have effectively invalidated that resistance. Okay, same with if you're going long, right? And here we see prices falling. We get a nice big engulfing candle. Does everybody understand the definition of engulfing?
Yes.
Hmm.
Okay. So here we have a bearish candle, here we have a bullish engulfing candle. This is a sign of strength. And do you see where this candle closed in comparison to the candles to the left? It closed above, right? Price continued and continued to close above each level of candles until you set a new higher high, right? Once you've done that, when you look at the structure across the top, and I'll kind of note out what I look at, right? My eye's naturally drawn to this angular level, right? But a retest is effectively completed when price comes anywhere into this zone where these wicks are between the candle closes and the wicks, right? So now look at how we change our view on support and resistance. Look, we had a break of the resistance. We retested it, confirmed it as support, and guess what we did? We went up and set a new higher high and a new lower low, or excuse me, higher low. So do you see how we create that stair step up?
Hmm.
Okay, we continue to do that until we end up in a premium that is more valuable to sell than it is to buy. Okay, when we reach that point where premium is more valuable to sell than it is to buy, price will come back down to where it is in fair value, meaning it is in its most comfortable price and neutral. And then the argument starts all over again. Who wins the argument, buyers or sellers, determines whether you go down or up. Okay?
Mm.
And that is just how simple trading stocks, futures, everything is, right? But where it becomes complex is not understanding what these actions mean and what to look for to confirm or deny or exclude or include those actions. Anybody have any questions so far?
No, sir.
I have a good question.
Yes, ma'am.
When you're marking the high highs and the low lows, are you paying more attention to the body of the candle, like where it opens and closes, or the wick?
So think about it this way, right? What's more important to you? Where price was or where it actually ended?
Where it ended?
Right. So when I mark out things, I look for the truest information. I look for the candle body close. But I also know that the wick is a probe, right? We were probing a level or testing liquidity. So I do know that there's a high probability that price can return back to that area. So I make note of it. But I do not treat it as the end all be all, right? There's
Yes.
more information when you have successive candle closes on a same level than if you have a bunch of wicks to it, right? Because if we look at that and we think wicks are the answer, right? We have 3 wicks right here that dead ended at a level relatively close. But what did price do? Right? This was just buyers probing if they had enough force to get through this level. When it confirmed they didn't, it came back down and picked up enough buyers to get there. Do you see what I'm saying?
Mhm. Yeah.
So that happens both up and down, right? This is a very confusing wick because you have a big wick on the bottom and a pretty decent sized wick on the top. So this doesn't give you much information as a candlestick trader, right? This just tells you it probed both ways. It's basically a failed breakout to the upside and it failed miserably, right?
Mhm.
But one thing I promise you is if you put a box around that body, open and close, price will return to it.
Mm.
Okay?
Compared to the box in general, or like in all parts of it, the top and the bottom?
Price will come back and either make a decision if buyers or sellers won, right? If sellers win, price will come back up in force as buyers, and sellers will take over and defend this level, right, at this candle and push price back down. If this initial push pushes people down into a discount deep enough, the buying force is going to push price action right through that box and the cycle starts all over again, only we're on the buyer side, right?
Mm. I see.
So think of my box as a tennis court, right? Here's your fence in the middle. You have sellers on top, buyers on the bottom. The buyers always want to hit that ball the furthest across the court they can with the most power so they can't be counteracted, right? So that this player 2 can't slap the ball back on them even further and cause them to miss and lose the game, right? So that battle constantly occurs where buyers look to buy at a discount, so below the price, right? And they want to send that ball as far past the foul line as they can. Sellers want to sell it as high as they can at a premium, and they want to push it as far down or past player 1 as they can get. Okay? And this is a battle that occurs every single candle. Okay? That's why you see some candles are red, some candles are green. In my case, my seller candles are black, my buyer candles are yellow. I do that for psychological reason, right? Because red and green candles are designed to instill panic. They're designed to elicit an emotional response. And I try and remove that from my peripheral vision in trading. Anybody have any questions?
Sure.
Nope.
All right, so let's go start diving into a little bit of technical analysis. Let's see. Which chart did I have that open, or do I still have it open? Nope, I think we cleared it all. Okay. So now you can see we're on a really big time frame, right? Weekly time frame on NQ. And this is where we start with our top-down analysis, okay? And the first thing I want to identify is what's my trend. Everybody understand what a trend is?
Yes.
Mhm.
Okay. So we can clearly identify here all the way back to 2023 and further, well, at least 2023 for sure, right? That we are in an overall uptrend, right? We see prices continuing up. Price action tells us we are setting higher highs and higher lows, right? And this attempted this attempted breakdown failed to set a lower low, right? All it did was retest prior lows, but did not set a new lower low. In order to do that, we would have had to set price below this point here. Okay? So we are still extremely bullish. We have not broken any weekly, monthly, or daily supports. We are still trending up. So I've identified that. I'll start paying attention to some key levels here. I see 23,121 is a good support. And I can identify that because if I put a line across it, I see candles closed under it, right? So we got clear rejection. Price came down. What did it do? It hit that premium discount zone, picked up all those buyers and pushed right up through it. And when it pushed up through it, it came back and retested it to confirm it was a floor and no longer a ceiling. As soon as buyers confirmed that there was enough support here, price continued up, right? So now we are making a system and a series of ceilings and floors. Okay, and you can identify that by putting a line across the top of every price reversal and under the bottom of every price reversal. So if it comes down, you put it on the bottom. If it goes up, you put it at the top. And do you see at the top here, price pushed up? We retested it once, we retested it twice, and it's held. So now, if we look at the most recent weeks of activity, we can clearly identify that we are very bullish because what? We have not set a lower high or a lower low. We are effectively trading in a compression, right? Candles are getting smaller, but the range is not changing. That tells you price is hunting for liquidity and it's consolidating, waiting for either news or liquidity to either break out or break down. And this is why I tell everybody, new and old, if you see 5 to 6 candles on a chart and you can put a box around it, right? Just like this, you do not take a trade until price comes out of that box, retests the top of the box, and that trade opens in the direction you intended to trade. And that works for top or bottom. Doesn't matter if you want to go long or short. In this case, this would not apply because we are looking at a weekly time frame. This would apply if you had, say, $1 billion you wanted to invest in NASDAQ and you had that kind of account size, you would wait for this range to break. Make sense?
Yes.
Yep.
Anybody have any questions? All right. Hearing none, we'll move along. So we'll get rid of this. Now, this is the main purpose for me in the higher time frames is I want to establish trend and I want to look at overall what is price doing. Are we ranging, are we compressing, or are we breaking down, or are we breaking out? So for me to see a breakdown, I would need to see a low that takes out this prior low and this prior low. And that tells me we have a breakdown. So I would need to see price close below 24,209.75 before I would flip my bias to bearish. And by doing that, we sweep this low and we break this floor here. Okay, and those are the things that are required based on price action to determine bias. Okay, now the third piece of that is that that action needs to break the overall trend and continue by setting lower highs and lower lows coming down. So you're going to basically do the exact same thing you see here, but in reverse. So now we would push down, we would come up and retest the bottom, we'd continue to push down, we'd come up and retest that bottom. Everybody understand?
Mm-hmm.
Okay. So now we go out to the daily and we start looking at what's the daily doing compared to the weekly, right? Now do you see we see more candles on the chart? What we are looking at is the price argument within the bigger time frame, the weekly. Now we're seeing 7 candles shows us 1 weekly candle, and we can see who won the argument over the last 7 days or that weekly candle. Was it buyers or sellers? Right? And that's what we do when we do top-down analysis. Think about it this way. For every time frame we go down, we're cutting the previous time frame candle open and looking at the argument inside that candle. Who had more control of that candle, buyers or sellers, right? So we're basically just looking at the overall picture, but we're looking at it in more intensive information loaded pretext. Okay? And we can do that all the way down to a tick-based order, which is a whole nother conversation we'll get into in the future, but that's where we start looking at price action based on order flow and not time-based, which is a game changer for people that are scalping pinpoint entries. So on the daily, I can clearly see our all-time high is up here at the 649.50. I'm gonna put a line across there, right? Just as a visual representation. I can see our most recent low was down here at about the 24, 170, 4, 5-ish area. Now I have a range, right? And I can see within that range, price is continuously trending. Can you guess it? Anybody answer that? Up, right? And do we notice, can you guys see what compression looks like now? So when we see compression,
Yeah, it's like kind of like narrowing, almost like a triangle.
right. So we see a nice big arc here. We see an arc with half the size. And now we see an arc with no size, right? So essentially, what you get is what we call a wedge, an ascending channel, okay? And that wedge is like a piece of cake, but it's got one flat side. That means price is managing to get pushed down from the top, but it's not able to get forced down lower to let that compression relief, right? So ultimately what happens, I'm going to put this in a little better visual here, because I have better tools to do this than a freaking highlighter. Ultimately what happens is we see price create a wedge, right? And so price has to make a decision at the bottom of that wedge, and this is what we call an ascending wedge. This has a high probability to break out to the upside, okay? Whereas if it was a descending wedge, right, and price was breaking across the bottom like this, it has a higher probability to break to the downside. Now this is where it gets tricky, right? This is what I was talking about earlier. This is the difference between implicit and explicit learning. When you are a new trader, you do not understand what chart behavior like this means, right?
Mm.
When people talk about bullish pennants, bearish pennants, a bear flag, a bull flag, head and shoulders, double bottoms, inverse head and shoulders, cup and handles, you guys absolutely have no idea what you're looking at. And it takes time behind the chart, looking at patterns, watching what price behaves and how it handles a particular pattern or support and resistance, to convert an understanding of what you're looking at. And then once you actually get that implicit learning down and you've seen something happen multiple times, then it starts converting to explicit learning where you can actually explain why it does what it does. Okay? And that is the one thing anybody teaching you how to read a chart cannot do for you. Okay? They cannot teach you that if the price does this every time I've ever seen it do this, it's a guarantee it's going to go up, or it's a guarantee it's going to go down. Nobody knows for certain, but people that have watched this happen long enough understand what it means and what the higher likelihood is, right? Typically we see price will sweep the bottom and then explode up. And we are definitely near that point in time where this pattern needs to make a decision. And I will always give more credit and weight to a pattern on a chart than I will technical analysis until it proves otherwise. Okay? Because the pattern is usually the dominating factor. The pattern is what basically, once you identify it, will lay out where your premium and your discount lie on the chart. All right, so we understand on the daily we have a range. We're still on an uptrend. We have a trend line we could retest. That could put us down to the 25, 655, 630 range before I would be worried about a full-on reversal. Okay, so I've already have an area to look at, the target for levels to place on my chart on the 5-minute. And I'm just going to pay attention, number 1, to where this rejection occurred, number 2, to where this rejection occurred, number 3, to where this rejection occurred, and number 4, to where this rejection occurred. So I have a pretty good map in my mind visually of what I need to pay attention to for targets based on the daily chart. I also look at the bottom side here, and I look at a fair amount of targets to the downside of what I need to be looking at here. And I'm always going to be looking at peaks and valleys, right? Where price goes up and comes back down, leaves a peak, you put a line on it. Where price comes down and goes back up and leaves a valley, you put a line on it. That is how you identify support and resistance. Okay? And you can see that it doesn't give you too many of those on a daily chart, right? So that's how you know that they are worthwhile on a smaller time frame. So now if we dial down to the 4-hour, and you see how we're getting even more candles now, right? Because we're looking at the argument inside of a bigger, higher time frame candle. So it's like cutting that candle open and watching the engine run inside. Okay? It's like watching the piston driving the combustion up and down. We see that going on here, just on a smaller scale. Now, if we look by the trend line we identified on the daily, Look at how well that's respected on the 4-hour. Everybody see that?
Mm-hmm.
This is the importance of higher time frame or top-down analysis. This will identify things on a smaller time frame that will keep you from making a bad decision in your trades. Okay? Because if you didn't do that on a higher time frame, you would not see it on a lower time frame. It would not tell you that this is a highly impactful decision point. If we get a candle close under it, I have no reason to look at trying to buy to the upside right now, and I need to continue my focus to the downside if I get underneath this line. This is where most traders fail. They typically try and trade against the trend. And I want you all to remember this very common term, this common mantra. The trend is your friend. And overall, the prevailing trend will win. Okay? So when you try and trade against the trend, you are in fact trading against a high probability losing scenario. Now, that doesn't mean you can't make money trading against the trend. Some of my single biggest trades have come from trading a bounce or a counter trend trade. Okay? It's up to us to let the charts and the price action determine what we do and when we do it. It does not matter if we are in a downtrend or an uptrend. We trade what the environment is presenting to us that says we can safely trade. So if somebody is constantly asking you what your bias is, your bias should not matter unless you are intending to trade against it. So in short term, on the higher time frames, we are still bullish, but currently the candle that's printing is bearish. So this is what I mean by it's okay to counter trend trade, but you don't do it for long term. And if you're looking at swing trading or investing cash into an overall stock and you're looking to hold that position long term, you do not want to counter trend trade. Make sense?
Yes.
Okay. On a scalping level, which is mostly what we do because we are trying to take short trades where we buy the impulses up or down, or the retest and the breakout, it doesn't matter to us in which direction that occurs, right? We are trading what it tells us we are going to trade. So bias isn't so critical in that point, but it is good to have an understanding of it. So with that being said, let's break it down to the 1 hour. So I can clearly see a lot of rejection across the 26, 106, even 120 range here. I can see a lot of support that steps down, right? And again, I can see this overall daily trend line is very, very significant support, right? We cannot close under it, and if we do, we recover it very fast. So that tells me this is a very significant level to pay attention to. And now when we have a trend line, price goes up the longer it goes off to your right. And if we were in a downtrend, price would go down the longer it goes off to your right. So on a 1 hour basis, I see a lot of price action around the 900 to 934. A lot of support, a lot of resistance both ways. So that's a significant area I'm going to pay attention to. I'm going to look at the bottom. What do we got there? Pretty much we'll got 25, 620 up to 25, 650-ish is a lot of support underneath. So that's an important area for me to watch. So now I have a range of numbers that I need to pay attention to. And the only thing I'm going to leave on my chart is this trend line. These other numbers, for example, I'm going to get rid of because they are going to become irrelevant to develop targets. Targets in which you can tangibly obtain while you're trading a particular session. Okay? And so now we're going to go down to the 15-minute. This is where I like to start adding some support and resistance, right? This is the most relevant price action to where I'm going to start trading. And so I'm going to start looking at structure. I see price expanded, I see price consolidated, price expanded, price consolidated, price expanded, price consolidated, price expanded, right? So now we see that price is coming back down from that expansion. Anybody have any idea what the most likely action is next?
Consolidation.
Absolutely. Can you identify the level on which that's going to occur? Where is on just looking at this 15-minute chart?
That'd probably be around like where the candles are like 3 a.m. to 6 a.m. on the next to the 8th. So what's that, like
Yes,
775, 750?
You got it. You seen that correctly, which I'm very impressed by, right? We look at this range of consolidation here. So if we can identify this appropriately, we know this is an accumulation phase, right? We know this is manipulation or distribution, right? And I would call that distribution because it dropped significantly lower than a manipulation needs to. And now the highest likelihood is price is going to return back to this fair value zone where it found neutrality. Okay? Price was neither discount or premium in this zone. This is where price likes to relax until it's given a motive to go one way or the other. So that right there, the fact that you can identify that puts you way ahead of the game than most average retail traders.
Hey.
Okay, so now I start identifying my floor. My floor, for all practical purposes, seems to be pretty much, well, right about here. So 604.75, I could tighten that up because we are setting higher lows, right? We are not setting lower lows. So I'm going to be a little bit more closer to this deep sweep here. So I want to be a little higher up, probably closer to somewhere about here. 620, 622. And I'm going to leave that on my chart. Then I look here, we have a peak here and a peak here. Can anybody tell me what the one thing we failed to do on this rally up that left this initial peak here? Can anybody tell
Set
me
a higher high.
Right. So if we failed to set a lower low and we failed to set a higher high, what does that mean for price?
It is uncertain.
That means price is consolidating, just in a bigger range.
Gotcha.
That is a continuation of rotation. Okay? That doesn't make it completely untradeable. It just makes it less likely to do anything predictable. So now we have areas to look at, right? We see our high up here around the 900, 980 range. We know in order to continue bullish, we have to get price action that closes above that range. We know in order to continue bearish, we got to get price that action that closes below this level. So then we'll go out to the 5-minute. And this is where the magic starts to happen. This is where we get more information, right? Now look at that red box we put on the 15-minute. Look at what would have happened if you took it short from the top, right? Eventually, you would have gotten paid in dividends. These aren't small moves. This candle was 80 points alone. This candle was, let's see. That one was 80. That one is 57. That one is also 57. So that would have paid you close to 200 points just trading a break. And look, what's this candle do? This wick pushed back up, tested this wick here, right? Closed most of that imbalance, but still left an imbalance and inversion. Does anybody understand? Does everybody understand what an imbalance looks like? Let's make sure everybody's on the same page here with that. Can everybody identify an imbalance?
No.
Okay. So an imbalance takes 3 candles to identify, right? And we're gonna just move this channel out of the way for right now. And what an imbalance is if we look at 3 candles, right? If we look at this candle, this candle, and this candle, okay? Everybody see that? 1, 2, 3 candles, right? We got the left side, the middle, and the right side. Let's go look at 3 other candles. Anywhere else here. What's the one thing that seems to stand out when you look at 3 candles, what the candle to the left and the candle to the right typically do? Does
They
anything
typically touch or meet
right?
or like go to the sunlight.
Your wick here overlaps and touches your wick here, right? So you don't have any imbalance in that candle where price hasn't revisited. What are you missing here?
The overlap.
If your wick is here and this wick is here, you effectively have an imbalance. It's called open price range, or for the fancy kids that like the ICT method, it's called a fair market value gap. Okay? And you can mark those out just by putting a box at the bottom of the left candle wicks to the top of the right candle wick and extend it out. And this is how they use it. Do you see where price action retraced into and then rejected before it came back down? This is what people talk about when you hear rejecting a fair market value gap or a fair value gap, right? But look, it ultimately gets invalidated. And it gets invalidated when this candle right here closes above it. And now look, right? You create fair value gaps in multiple quantity. So if we go look at another one you could use for an entry, what do we see here? We see a big impulse up. We see almost no candle on the top. This candle leaves a overlap here, touches the candle on the left. Not a fair value gap, right? But this candle, what do we have here? A big body, no wick, no overlap on the right side, right? So if we make a box from this wick to this wick and we pull that over, where's a good entry for your long?
Bottom of the FPG.
Right. Okay. Now, if we combine that with a chart pattern, this is where this actually gets some power. Okay. And when we combine that with a chart pattern, such as a double bottom, right, that letter W, and we use the neckline of that double bottom right here, where that support zone is, now what becomes even more powerful, right? You have a better area and more confluence to say this trade is going to the upside. If you get candle closes below this area, price is going to the downside. Do you guys see that?
Mm-hmm.
Yes.
That is the power in knowing your controlling pattern or structure when you take a trade. Some traders get a little too zoomed in on their charts to pay attention to things like that. Okay?
Mm-hmm.
And these are things that have existed long before ICT was a thing, TJR, all those people, right? They're just rebranding things that occurred naturally in the market and developing great marketing so that you can pay them for it.
Hmm.
But if we look left and we pull that box to the left, look at what price did underneath it, right? Still respected this as a zone, not a hard level. Any questions?
Nope.
Okay.
Good.
Now, do we see how price over here ultimately inversed price here? Right? All that big open range we left got negated over here. So this is not an immediate entry to short. And it's not an immediate entry to long. It is just another confluence of what price is going to do. Everybody see that?
Mm-hmm.
Okay. So our job as traders is to legitimately eliminate probabilities. And once we have eliminated the most probabilities, whatever remains is your highest probability of success. That's how we take this from being a casino to a money printing machine.
Do you mind actually repeating that again really quick?
Which part, Reese?
The one about probabilities.
So when we are looking to take a trade, our job is to eliminate probabilities to the most logical probability that exists. Meaning there's a high probability and then there's a low probability. We want the highest probability setup, right? We want the highest odds of winning. So by eliminating the lowest probability of winners, we are excluding the highest probability of losers. And I know that sounds
Okay,
like
that
a
makes
bunch of
sense.
word salad, right? But what it is we are systematically stacking the odds in our favor. Okay? Let me ask you this, and this will give you a real life example. How many people here have played blackjack in a casino?
Yep.
Probably safe to say just about everybody here has done that, correct? If you are sitting at a table and you get dealt two face cards, there's only one point that can beat you, right? Ask yourself this question. Have I excluded enough to give me that 1 point edge to win this hand? And then ask yourself, would I consider splitting these two cards and cutting my chances in half? Right? That's what I mean by probability evaluation. It's essentially the same thing for a guy asking yourself, if you had a 12-inch member, would you cut it in half? You're probably going to 100% of the time answer no. Is that fair to say, guys?
Yeah.
Right. And I promise you, if you ask the female counterpart to what we do, if they'd ask you to cut it in half, they're probably going to say no as well. So that's what I mean about stacking the odds in your favor and reducing the environment from a casino state to a high success probability machine. Right? All right. So now that we're on the 5 minute, let's go look at where our targets would be. So I know we were looking at upside targets like 930, 940. We pretty much well swept all those. I'm still going to put them on the chart because I think we are going to return back there in fairly short time. So I like 930, 940 range. If I had to pick a hard target in there, I like 935 because it's a psychological level. It's a quarter level derivative. So that's where I'm going to put my first upside target, even though we immediately were above that and crushed it. So it's still a good point of interest. It's a breakthrough. It's a retest. It's held price above. It consolidated around that level. So I'm going to add that on my chart as upside target 1. Right? Target 2. I'm looking at the top here where price rejected, price accepted, price failed, and the breakdown. We need to reclaim that to continue our overall trend. So that to me is about here at 975, which also lines up with a quarter level. And we will talk about quarter levels immediately after this, right? Again, psychological level. So I am going to label that upside target 2. And look, when you guys are doing analysis, you don't have to be precise. You just have to be right, right? Like if you get into the right area, you're already on the right path. You don't have to nail this to the exact penny. It's almost impossible, but the more you do it, the better you're going to get at it, the closer you're going to get. And again, that's part of that implicit learning converting to explicit learning. So next target on top of that I'd want to see that price getting swept. So that price right here, the high is 985.50. So I want to see 986 or 990. But for this purpose, we're going to just choose 986 because we need to see a sweep of that high. So price action dictates that that is a price target.
And by sweep it, you mean just price goes to that level.
Price has to wick past it, correct. Means
Wick past it.
doesn't have to close above it, but if it goes there, it's picking up orders that reside there or liquidity, right? So for me, this is that line we put on the 15-minute chart, right? So this is our 15-minute resistance level. So I'm gonna just add a label and make that my fourth upside target. Just makes perfect sense. Now, we have 4 targets to the upside. One's already been negated in this session. So we have 3 left. I usually like 5 up and I like 5 down because you can see price can move fast and it can move far, right? Usually 5 targets up, 5 targets down gives you a good range. So if I've got to look here, now we need to go look above the 15-minute and we need to look with the 5-minute. What target would make more sense above these levels? And zooming out, I don't see it on a 5-minute. There's not enough data there, so I got to go back to the 15-minute with my targets in place and look left. Well, look, we already start seeing a bunch of rejections, right? So let's go look at the level that rejection occurred. So 26, 120, 121 to 107. So we have a clear rejection and reversal with a big gap down from 120, right? We got double top peaks, just about equal highs, right? What did I tell you about when we see equal lows on a bigger time frame? What typically happens? Price will push down a little deeper before it comes back up and reclaims it, right? So when we see equal highs, same thing happens. Price is going to push back down deeper before it comes up and reclaims it. So my 5th target would legitimately be right here at 26, 120. That is a decision point that needs to be rectified. You have 1, 2 rejections on it. You typically need to see 3 or 4 before a decision is made. Okay, any questions so far on how we're developing targets?
Can you explain why we did target 2 and 3 again?
Okay, target 2 and 3 come from the 5-minute time frame, right?
Mhm.
So if we go look at the 5-minute chart, and let's look at target 2 and 3, right? Here we have a rejection on target 3 and no retest of target 2, which prior price action confirmed as support.
Mhm.
See that? See how price has behaved in these levels in the past. And what do? We use prior past history to predict future behavior. So if you see, and you can see my levels are spot on looking left, look at how many times price has come right to these levels and made a decision. This is how you can this is how you can confirm your analysis. When you have a line that runs completely across your chart left to right, this is exactly what you should see when you are on the right trail. You should see a bunch of candle opens and closes and wicks rejecting or accepting right at that level. Okay?
Yes.
Any other questions? All right, let's go get some downside targets, which I'm sure we are going to invalidate most of what I'd come up with already. So, which actually we're not. So looking at this, my first downside target, yeah, we did just hit it here in the candle, couple candles before here. I would have had the 76 based on over here and here. Knowing a quarter level, I like this here. So we are right on what would be my first downside target. Just looking at price action behavior here, support here, excuse me, resistance here, we blew through, we held above, we came back down, we retested, came back down, and ultimately blew through and confirmed. So I like this level. If I continue to look left, catches consolidation, catches tops, it's acting like a point of control. Price gets under it, comes back to it. Price gets over it, comes back to it. Make sense?
Yes.
Do you see how far back that level is heavily respected, one way or the other?
Oh, yeah.
That is why it's a target. Okay? Because I want to know where price is most likely to come back to. Okay. So that would have been my first downside target if we were still developing this before price actually got here. We're actually moving pretty good tonight in Asia, so it's hard for me to keep up on pace here. So the next one I would look at is going to be the tops of these candles, and what makes the most sense in between. And right now, to me, this level looks pretty good, so about 745. And I'm going to put a line on it. Now, if we look left, what do we see, right? Price goes up to it, comes back to it, bunch of closes and rejections above and below. This is how you validate that target to be credible. Okay? It's in the middle of a fair value gap. Even though that fair value gap's already been rectified, you see consolidation in between the first target and the second target. It's a valid target. That is how I rectify it and put probability on it. Okay, so let's go look. Now look, here we have that 15-minute target, right? Our support. So let's look left, and we can clearly see that just by the overlap, we need to adjust this down a little bit. So let's see if I take and drag it down to the candle bodies, I like that better. So there we're at 615. Catches the wick, catches a bunch of candle closes, right? Price gets below it, instantly recovers. Price gets below it, instantly recovers. It's a valid target. Okay. That's our third downside target. Now, can we do more targets to the downside? Anybody, can anybody just see off of the little bit of stuff going on the chart right now? What happens if we actually break and close below this downside target?
It's going to be a lower low.
Correct. We are going to be at the bottom of testing that trend, right? So it would be irrelevant to try and put a target anywhere in between here and here, because if you get into this area, you already have your target on your trend line, and you would expect price to behave as it did previously. So you expect a bounce, right? Now, if price gets here and this trend line breaks, you wait for price to do exactly this. You wait for price to do what? Anybody know where this is going? If we break a trend, how do we trade it?
With the trend.
an overall observation, but what do we wait for to confirm it?
Oh, the retest.
You got it. So if price continues down, breaks the trend, we need price to come back up, test the trend, confirm we are going down, right? And at that point, this is our entry, right? We don't just blindly have an order here. We need price action that pushes up and leaves a wick, not a body, at or slightly below that trend line. Make sense?
And so how do you catch that though?
So we'll dial into that, and I'll show you some tools that really help you
Okay.
do that, right? We're all going to
Mm.
actively practice taking that same trade together, okay? Just on a smaller scale. So that you really
Sounds
get
good.
confident with understanding how it works. But primarily, this is just, a pretty in-depth overview of how we develop targets, right? So we know when we developed our targets that the 15-minute chart basically gave us a range, which is the upside target 4 and the downside target 3. I would not expect price to break either one of those extremes until we get into, say, London or New York. Make
Got it.
sense?
Mm-hmm.
And now, once we've traded into these zones, you've got two choices. You can leave them on your chart and try and develop new targets by looking at historical data and looking at structure and telling you if there's a overall pattern that is going to give you a bullish or bearish target higher or lower. And those are all things we'll get into in weeks coming, but I just kind of want to get everybody to the same page and at the same skill set. Okay? So if you're already leaps and bounds ahead of this, I apologize, bear with us. I know we only get one night a week on the free side. But I am going to try and record and post as much of this as I can so the people that aren't quite there can review it. Okay, so last final thought on this downside target. If we get below it and close below it, I'm going to flip my bias to bearish until proven otherwise. Meaning I'm going to look at this as a longer term decision point where price is probably going to decide to go further down because it is close to that trend. It has been tested multiple times, right? So if it doesn't compress and break to the upside and I don't see a sweep and recovery, that to me is confirming a change in state of delivery in the market, meaning we have flipped from an overall bullish scenario to a high probability bearish scenario. All right. So, Jack, I think it was you that had the question of how do we trade break and retests? Let's go look at a 1 minute chart. Okay. So on a 1 minute chart, pretty easy to see the stair step ladder down, right? You could easily draw a line and see when it gets above or below, right?
Mhm.
So this is what I try and teach everybody that's new to trading, how to trade break and retests. Okay? And this right here would be a perfect example. If you grab, and you don't need all these candles to print, you only need about 2 or 3 candles. So you grab the bottom of the body and you go, let's say just to this candle here, right? And then pull that out and you want to try and predict, you want it as long as you can get it. So let's look at this and break this down. Our setup that we're waiting for in a break and retest is for these candles to break below this line. And it has to break with a body close. right? Which is exactly what happened here. This candle broke and failed to close above the trend line. This candle opened and did what? It pushed up to that trend line and it left a wick, not a body, below the trend line. When this candle closes, you enter the trade short, right? So your entry would be at the close of that candle under the trend line, okay? And your first target for profit is going to be the bottom of these two candles. So what that would look like is if you took a trade right here, right? Your entry would be right here at this trend line. As soon as this candle closed, so your candle would close there, your entry would be here. Your take profit is at the bottom of this candle. Your stop loss needs to be above this wick. So you're risking $125 to make $520. Does anybody know what that means?
That's like a 4 to 1 profit loss ratio.
Correct. That is a 1 to 4 RR. Okay? And we do that based on a simple break and retest. Now, what invalidates this? Where would this not be a good trade? You only need one candle to answer that question. This candle right here. If this candle leaves a body on or above this trend line, you invalidate the trade. We need
So what exactly is this trend line going over? So we're starting at the bottom of the body of that first bullish candle.
correct.
And then
So we're going to wait for 1 to 3 candles to develop, right? And the trend line is going to be bottom of the body, bottom to the body. We don't want wicks. When you're doing break and retest on a smaller time frame, right? We want the bodies. Because if you're on the body, it doesn't matter how accurate you are, right? Because look, even here, right? If I pull that trend line over and I catch these bodies, you still leave a wick on that trend line. You still enter. You do not leave a body crossing that trend line, right? So now look, we can do the same thing when we are trading down. We wait for that reversal, right? We see the reversal right here. It's confirmed. We put a trend line across those bodies. Okay? Now we wait for price action to break above that trend line, come back down, leave a wick, and then we take it long. Make sense?
Yeah.
If it doesn't leave a wick, it is not going to pay you. This is how break and retest works. And I want everybody tonight to practice this, right? Do it on a paper account, and you're going to learn. You'll see it naturally, right? When you put a trend line on the candle bodies, if the price, like this right here, cannot break above it and close above it, is going to continue in that overall direction, right? These are the trades you wait for. You see a big move down, price is only going to do one of two things. It's either going to retrace 50% of that move down before it continues down, or it's going to trade sideways, right? So every time we get a big move down and an opposite color candle prints, or we get a big move up and an opposite color candle prints, if it goes beyond 3 to 5 candles, you are more than likely going to consolidate for at least 45 minutes or more before you see another move down or up. Okay? Those are called bear flags and bull flags. This is called consolidation. This is what I call grinding consolidation because overall you're still moving down, but if you look at the candles, price is not going very far, very fast. So this is a kind of trade where if you're in it, you need to be in here at the top and you don't do anything until price breaks above that trend line and closes. And if you are trying to take maximum profit, price will break above that trend line, it'll retest it, that's where you get your exit. If it comes back against you unexpectedly, okay? And you can take that trade and hold it until it does exactly that, break that trend line. Make sense?
Mm-hmm.
If you're in the right trade, that trend line is never going to get broken until the move is over. And usually by then, you should be out in profit. You should have been at your target. Make sense?
Yep.
Okay. So that's everybody's goal from tonight. I want you to take tonight, whatever days you trade, before you start putting any real risk on, whatever time frame you trade on, grab candles like this, put a trend line on it, you wait for a break and a retest of that trend. That retest cannot leave a body on the trend line, only a wick. Your job is to take it short on the candle close and target the bottom of that controlling move. And I want to see you do that for a couple days and then come back and talk to me about how much money you made and if it's a valid concept. And I don't want you, I don't even want you to apply a strategy. And this is not a strategy. This is just trading price action. And I want to be very clear with everybody, and most of you have heard this from me. Okay? Price action is the language we speak, right? Strategies are the sentences that help write the language. If you do not understand the language, you will never apply a sentence correctly, right? So, in order to be a proficient trader, you need to learn the language, which is price action, before you can apply a sentence, which is a strategy. Strategies are rules-based entries and exits. They are not the get-rich-quick scheme that everybody tries to push the narrative on. It all starts with price action. And when you learn how to use them both in conjunction, you will become the most successful trader you have ever been to your trading journey thus far. I don't like certain strategies, but if they make sense to you, I would never steer you away from it, right? So use a strategy that you understand. And we're gonna segue into that with the strategy I use that is based on price action. Okay? There's no magic bullet here. I didn't reinvent the wheel. I didn't rename something that's already existed. I just used what was publicly available and paid attention, right? This is where implicit learning converts to explicit learning. And this is where people benefit from knowing me and being in this Discord. And that is using a basic structure map called quarter levels. Okay? So we'll get rid of all this crap. Actually, we'll just open this chart and we will put an indicator that I built on this chart that does exactly that. Maybe, if it'll load. There we go. That's weird. loads 3 times after I clicked it once. Alright, so this is a big code. It takes a little bit to load. But now you can see we have some numbers and levels here, right? And the first thing I want to point out is let's look at candles. Let's look at where the closes and the opens are. Let's look at where they line up with targets. Let's look at how they react when they get to a level. Let's look and see if we break one, does it get retested? Anybody see that? Everybody see how these are literally respecting these lines and treating them like support or resistance? Let's go down and break down what quarter levels are. Okay. Quarter levels, and these quarter levels are just the black tag numbers, the 0, the 25, the 50, and the 75. Okay. So that means NQ trades in price increments of 100 points, right? So we got 25,900 all the way up to 26,000. There's 100 points in between. We are marking out 25-point increments. So this is 900, 925, 950, 975, all the way up to 600, right? Or, excuse me, 26,000. And we do that all the way up and down. And it restarts at every 100-point increment. So it works above and below, right? Doesn't matter what the price is over here. They are going to be at the same price in every 100-point level. Those are the black lines, okay? The most significant level in that black line is the 50-point value, right? That is where you're going to see price either continue bullish or bearish most of the time. Can anybody tell me why that might be?
Psychological level.
Correct. And it is also the halfway point between a zone, right? And that's what these quarter levels are. They're psychological levels. If you as a new trader, or you as a trader period, had a big price range that you had to identify an entry or an exit in, are you going to just pick out a random number like 25,933.25 as a place to put an order and exit? Probably not, because you're never going to remember where it was if you're managing multiple trades. Well, institutions do the same thing, right? Retail traders do the same thing. Psychologically, their mind gravitates to a solid round number, a quarter level. Okay? Everybody understand why a quarter level exists now?
Mm-hmm.
Okay? Perfect. And that applies to any asset you can trade. You just have to figure out what psychologically makes sense on that asset. And for this purpose in gold, it would be every 5 points or 10 points. In ES is every 5 points, right? Silver would be every 1 point. So that's a lot of quarter levels, but you know, they all trade inherently different. So, except for SPY, ES trades in typical unison with NQ. The difference is that ES, when it makes a 1 point move, NQ amplifies that move by 3.5 times. So if we move 1 point up or down on ES, NQ usually follows by 3.5 times that movement, meaning we will move 3.5 points for every 1 point that the S&P 500 moves. That is called divergence and convergence. And ES is a good indicator to predict what NQ is going to do. So if you're going to trade with the most information available, you put an ES chart and an NQ chart side by side. Any questions so far?
No, sir.
Okay, so now let's talk about the other numbers that are on my chart that are relevant. You'll see we have the same numbers that repeat at the 10, the 35, the 65, the 80, and the 90. Okay? What we do is we consider these temperature levels, these red tags, we consider them confirmation levels, right? So if we take a long position off of say a 25 or a 50, we use the 65 and the 90 with candle closes above to confirm that the trade is continuing momentum. If we get a rejection at one of these levels, we know it's a good opportunity to enter short. So we use the red levels to manage a trade we're already in or look for high probability rejections. Anybody have any questions? Think about it as confirmation following you up as price breaks above or below the prior level, right? So if we get price action that breaks above the 50, and I entered here on the 35 because it's got a high rejection, by looking left, I see a bunch of rejection over here, and you can see it was treated as prior resistance, confirmed as support, retested multiple times and held. I would say that's a pretty good area you could take a long off of for at least 10 points or better. Okay? So let's say I entered this trade here and I get candle price action that pushes above the 50. Well, I need the candle to close above the 50. I need it to push up a little higher, either halfway into the zone or up to the 65, come back down, retest that 50, and then continue on. And as long as price continues to do that and close above each one of these levels, I stay in that trade long, right? And once price rejects one of these levels and closes below, the level below it is where I exit the trade. That is how I use quarter levels to pick up and trade 100, 200, 400 plus point trades. Okay? And once you get confident in trading these and using the levels below you as confirmation for support, you don't need anything else. You don't even have to look at anything else. Just trading the levels becomes simple and consistent. And on my chart, you can see how the red and the green lines are flashing. That is your most current level of support in the green underneath you and resistance overhead above you. And that's what this indicator does. It shows you your closest level of support and your closest level of resistance. In this case, it is a 55-point range. And that is the other benefit. And by the way, anybody that wants to use this, play with it, there is a free version on TradingView you can download. You just do not get the heads up display and you do not get the watch zone. Okay? No big deal. You don't need those to be any more or less successful. They just help you focus on where you should be watching for price to make a determination. And again, these indicators are not designed to make you buy or sell. These are designed to help you learn where you should be looking, where you should be asking, is this an area that I can take a trade? Does price say I have permission to take a long here? Does price say, do I have permission to take a short here? And the reason I put the flashing support and resistance is it wouldn't make very much sense for you to take a long position darn near at the top closest to resistance, would it? Or a short at the closest point to support, right? So that's why I put these lines that stand out by flashing to show you if you're near one and you're looking to trade counterproductive to what it is showing you, you are entering a high risk trade that is more than likely going to fail than it will succeed. So if you're looking for a short position, take an entry near the closest resistance. If you're looking for a long position, take your entry at the closest support position. Make sense?
Yes.
Mhm.
And this indicator will help you identify where that closest level is. And if you're in the middle, we have a saying. Anybody know what that saying is? Any of my old G's want to point that out?
Don't diddle it in the middle.
You got it. We don't diddle in the middle. So we do not want to take a trade anywhere in the middle of a level. Right? And where's that price right now? In the middle. That is the highest probability for failure you will find.
Okay.
Okay? And this indicator on Thinkorswim, the one you would want to get, that's free, is called Quarter Levels Auto Recentering with Advanced Mode. Okay? And that will give you the quarter levels with the active support and resistance. All right, so now the beauty of this, and the last piece I'm going to talk to about it, is look at how well those quarter levels map structure, right? When you pick 4, maybe 5 tops levels, so you got 1, 2, 3, 4 levels right here. If price cannot get out of those 4 levels, what are you in?
Consolidation.
Bingo. There is no monetary value for you to trade consolidation. Now, when you start seeing price open up more levels, right? That's when you are getting your value. And let's talk about the last 2 numbers I haven't talked about. The 10s and the 80s. Okay? The 10s and the 80s act like either an accelerant, so either a gas can, or they act like molasses. They either super accelerate your speed in direction, or they act like molasses where they slow the price action down and create consolidation. Okay? Most of your high value reversals occur around a 10 or around an 80. And when you put those on your chart and you go back and back test that, you're going to see, I'm not kidding. What's this number right here? 25,980, right? Where did price reject and close under? The 80,
The 80.
right? Where did it fall all the way down to?
The 80. Okay.
Right. It's a 100-point trade. Do you see what I'm saying? You go
Yeah.
back and you look at those purple levels. Look right here. Where did that price close under? 810.
10.
Where did that price wick all the way down to?
50.
Right. Where did that price close at?
80.
There you go. When I tell you the 50s, the 80s, and 10s are the numbers you need to pay the most attention to for the biggest trades. I'm not kidding. I didn't just
And
pull it out of my arse. It is a real thing.
is this specific to NQ or all of them?
This is specific to NQ, but you could tailor it to fit any asset you want to trade, right? Anything that has volatility and volume, like gold, silver, platinum, Tesla, crypto, right? You just have to figure out, like, if it's moving in 100-point ranges, you have a 25-point value. If it's moving in 50-point ranges, and when I say points, I'm talking about dollars, right? So if you have a stock that's trading at $451, your range is most likely going to be 10 points, right? Because it takes 10 tens to make 100, right? If you're dealing with something like gold where price is at 4,000, right? You're going to be at the tens because you're not in the tens of thousands. So if it's an asset that's under 10,000, likely quarter level is going to be every 10 points, right? Psychologically, and the easiest way you prove that is go put a line every 10 points. Just on any chart, you should be able to pretty much add a line like this, right? Just put a line that runs across your chart at that 10-point level. Then go back and look. How many candles closed at it? How many wicks closed at it? And if it has credit, you leave it. And that's how you validate a quarter level on any asset you trade. Any questions? Now, the last thing I'm going to point out about this indicator is this indicator works on confirmation. It does not predict anything. So this level will stay red as resistance until a candle closes above it. Until then, it treats it as a wick or a probe. So it will stay as active resistance until that candle closes above the 80. So keep that in mind if you're using the free side. All right. Any last questions on quarter levels?
No, sir.
All right. So now we're going to touch base on a little bit more advanced stuff that's still mildly easy for new traders to kind of grasp, okay? And what we're going to talk about here is we're going to talk about EMAs and lagging indicators and VWAP and the impact they have on your trades, okay? So the first thing we're going to do is we're going to start with EMAs. And I'm going to leave this up. If you guys want to take a screenshot, these are the EMAs I use and the colors I have them coded to. I highly advise you to put them on your charts. And then we're going to break down why I use them and what they mean. All right. Everybody got it?
Mm-hmm.
Perfect. Okay. So indicators, EMAs, right? On my chart, this light blue one right here is your 9-day. That is the estimated moving average of the cost of the stock over the last 9 days. That is your fast EMA. That is telling you and going to react the fastest to what price is doing. You can use this as a confirmation in a trade. If price is continuing to close above it in an uptrend, you stay in the trade. If it breaks below it, then you need to pay attention. Price is running into resistance. Okay. The next one we're going to talk about is the 21 day. A little bit longer time in history. Gives you a little bit more of a smoother trend, right? And you can see how these start curling and changing direction as price changes with it. There's a theory and a trading strategy out there called the 920 or the 921 cross. And that says when this 9-day EMA crosses over or under the 21, if it crosses over, you take it long. If it crosses under, you take it short. And this is what that looks like. Do you guys see where the 9-day crosses under the 21 day? Right? Price stays under it. You wait for a retest, you enter it short, and look at how long you could have stayed in that trade, all the way down to here. And again, it is a break and a retest, which usually occurs where that cross occurred to begin with. So if you're coming up and you see a big peak starting to form and you see your 9-day cross under your 21 day, wait. Wait for price to come back and close below where that crossover happened. Okay? And if you did that, your entry should have been right here at 56.50. How much stop loss would you have needed to take that trade? The high of that candle was at 60. You needed 3.5 points. That is, for all practical purposes, a top tick entry. Okay? Anybody have any questions about that?
So we're waiting for the 9-day to cross under the 21. And then once we have a candle that retests
That cross.
the level that it crossed under.
Right. And you need it to close
Okay,
under
watch.
to validate it. Right? So price opens, pushes up towards it, and starts falling. You take an entry right underneath it. Your stop only needs to be right above it. Okay, so
Wow.
this is more of a gamble, but it's still a high probability gamble, especially when you combine it with structure and price that is starting to roll over, right? When price looks like it's starting to change direction. Okay? And you'll see that because the EMAs will start aiming down. And if you look, you don't see that 9 and that 21 cross too often, right? And where you see it cross to the upside here, look at what price did. It opened and pushed right back down to it. You could have entered here and taken it long from here to here. So that's just another added confluence to add to your tools as a trader. You don't need to start doing it now. It takes time to get used to it. And you must understand that these are acting based on price prior. These are not predictive, they are lagging. They are telling you what price has already done. So that becomes problematic for some trades, especially trades in chop. But it becomes very handy when trades are setting up in momentum, right? Because the one job is once you get broke underneath that, you can watch that 9-day, right? And your trailing stop just needs to stay above that 9-day. And this is a perfect example. If you use the 21-day as your trailing stop, every candle that closes under the 9-day, you move that trailing stop down. Candle close, you move that trailing stop down. You lock in the most profit and leave that trade with plenty of room to run and breathe without getting stopped out prematurely, which is one of the biggest risks a new trader almost always encounters. Okay? So that's the 9 and the 21 day. Now the next one I add is this black line here. This is the 50-day EMA. This is a good way to instantly develop your trade bias on a minute by minute, session by session basis. Look, price was bullish when we were trading above it. When we start trading below it, price is bearish, right? This is where institutional orders typically enter. And when I say institutional orders, I mean small to mid cap stocks. I mean your smaller hedge funds, your smaller asset managers. We're not talking big banks, big financial institutions. They enter on higher EMAs, such as the 200-day, which is the blue line here, or the 500-day, which is the orange one, or the 1,000-day, which is the green one. And let's look at what happened when price came down to this 1,000-day EMA. See what happens when you get into that level of depth on a 1,000-day moving average. Price reacts strongly and impulses out. Do you all see that?
Okay.
And now look,
Mhm.
Yeah.
we broke through the 500-day, we retested it, confirmed it, and we traded down until we tapped into liquidity that said, whoop, this is the best discount area. This is where we're going to pick up our orders, and price reversed, right? And price printed an engulfing candle right here that impulsed out and took over almost 4 candles. And it left what? Can anybody tell me what this imbalance left?
Fair value gap.
You got it. So what are you going to do? You're going to mark that out and pay attention. You're going to grab that wick to the left, wick to the right, and you're going to slide that out. Because if this turns into an inverse head and shoulders, your most valuable entry is going to come from a retracement into this fair value gap that holds, right? So you're going to wait for price to wick down into it. You're going to wait for that next candle to open and show that it's going in the direction up. And you're going to enter that trade. And that will typically buy you your best value. And your first target, can anybody tell me if you enter a trade here where you're going to target? Just by looking at the 5-minute chart.
The doji, what's like the 800 there?
I would be aiming more here, the bottom of these two candles, right? So 789.
Okay.
Okay. Then I'm going to watch. If price gets on top of the 789, guess where it's going to go next? It's going to go clear the next imbalance, which occurs here at the top of this wick to the bottom of this wick. So now I'm targeting underneath these candles here. That would turn into a 75 plus point trade. Okay, and that's all we need as confirmation is if we get a candle close above here, then we know we are going to go and test here. What I can't tell you is how long it's going to take to test from here to here. But I can tell you, based on behavior here, what we're going to do moving forward. So now, if I took a blind stab right here, right, and I added a buy order, in this fair value gap, either at the 50% or bottom, without confirmation, we are now in the trade. My stop loss only needs to be at the bottom of that candle. It's $185. If I'm targeting here first, That's 650. This right here already tells me I'm over leveraged. Okay. Now me, as a trader, this is where most traders fail. They think every fair value gap is an enterable trade. Okay. That is not the case. You need confirmation. You need to make sure this candle closes inside the fair value gap and the next one opens and pushes away. Otherwise, all you have done is bought into a bear flag. And that is where price comes down, bounces 3 to 5 candles up before it continues its overall direction down. Do y'all see that? Okay. Everybody know what a bear flag or a bull flag is?
No.
This is a perfect example. Okay. Think about it as, how do I want to illustrate this? I think we'll just do it this way. Okay. Think about these 3 candles as your flagpole. Okay. And then think about let's go with this guy. Think about the top of your flagpole here, and this your flag, right? So when you put them together, that looks like a flag, right?
Mhm.
Okay. A flagpole has expected behaviors. No more than a flag pattern has an expected behavior. No more than 3 to 5 candles and no more than a 50% retracement of that entire pole. Okay? And if you can't visually identify that, this is where a Fibonacci tool comes in very handy. You grab the bottom of the pole to the top where price reversed. And a true flag is going to only retrace 38.2% or 50% before it continues moving up. You can, once you get good at identifying these, you can figure out exactly where that entry should be, right? You either enter here on the green line or here on the orange line. And you can tell exactly where that price is going to go simply by using a trend line to do this. All flags will pay, if it's a bull flag, will pay 50% of that pole overhead. So if you take a trend line and you measure from top to bottom of that pole and you put that trend line at the 50% mark and you put a target or a line across that level, what happens? If you bought in at the 38 or the 50 and you hold it, price goes all the way up and takes your target out right here. Do you see that?
Yes.
Mhm.
Okay. Now there is many patterns on NQ. You can do that exact same thing with measuring out with a trend line and getting a target that hits a high percentage of the time. Double tops and double bottoms being the number one, in my opinion, pattern that once you confirm pays 100% of the time. Now, realistically, double tops and double bottoms have a 15 to 30% failure rate. But when you trade them with confirmation and tools like I'm showing you, you can reduce the probability of the losers. Okay.
Mhm. I have a quick question.
Yes, ma'am.
So where we drew the flagpole,
Yes, ma'am.
why did we choose that one and not the bigger
This one.
flagpole right before? Yeah.
So this again is also a flagpole. right?
Oh,
So that is what basically, and this is a really advanced, very hard to understand um, theory called Elliott waves. And Elliott waves consist of a repetition of flagpoles and bear flag flagpole, flags period, either bear flags or bull flags, right? It's just there's a different way to measure them, and you have to count them, and then there's things that like ABC wave or wave 1 through 5. A lot of things that take a long time to learn and understand, and more so than we have that I'm willing to give here. um, and it's one of those um, strategies that I'm aware of, and I understand where it fits, so I can identify it on a screen, but I don't inherently use it, right? I use it to know where I'm at in a structure, and that's about it.
Got
But yeah, so perfect example. If we go back to this flagpole, look at the retrace, 50% textbook, right? And if we do that same thing and we measure out 50% of that pole, right? And we measure out 100% of the pole, but we place the start of the pole on the 50% line. Look at where price went, right? That's our upside target too. Sorry, I'm gonna be a little bit precise about this. And we didn't get there, right? And that's because Elliott waves took over, or sellers took over, and we got too far into a premium. So it made more sense for the market to sell, but you got pretty close. Like if you would have taken that trade, you would have made seriously good profit,
yeah.
right? So again,
Yes.
just gives you a good visual confluence on where and how to trade. It answers like my 3 questions. Why am I taking this trade? Because it's a flag. Where am I taking this trade to? 50% of that flag pole above. Where shouldn't it go? It should not close below that 50% line, right? So that's how I use that approach.
Thank you.
And you can do that on any one of them you see, whether it's bearish or bullish, right? A solid flag is always going to defend the gains it made. And what I mean by that is this flag defended all of the gains that it made. And this is why I say you don't put all your eggs in a basket on a fair value gap, because look, you left one here and it never got retested. It got blown through, right? So if you would have tried taking an entry based on a fair value gap here, right, you would have got completely disrespected and you would have lost instantly. So that is why you have to have more than just a fair value confluence to enter a trade. And this is exact representation, right, of why we pay attention to bear flags and bull flags. Because if we looked at this, even though the candles look smaller, if we take the impulse up and the impulse down, and you'll notice, because we are going down, I pulled that from the top to the bottom instead of from the bottom to the top. We can now see our 50 and 61.8% retracements. 61.8 is considered your golden entry on any Fibonacci retracement. This is where you get the maximum value for every dollar you invest. Okay?
Mhm.
And if we take that same principle and we pull that flagpole and we put it at the 50% mark, then we know we should be able to safely target the 677 to the downside as soon as price breaks below this low. Okay. Now, the only confluence you need if you enter at the 61.8 or the 50 is you just need to make sure price continues to close below each level. Make sense?
Yes.
Okay. And your ultimate confirmation that you need to hold that trade down to this target is when price closes a candle below these closes here. That means the probability of that trade coming down and coming back against you is much lower than it would be if price closes above this level. Because if price closes above this level, what is that telling you? Based on the action here, and if you look left, the action here. That's telling you it's confirming as support, right?
Yeah.
So if you get a level and you have a downside target and price cannot close below, effectively setting a lower low and a lower high, your downside target is no longer valid. Do you see how we seek permission by price action to continue a trade? We are not trying to force a trade. We are not trying to take a hero target and think we're going to get 100 or 200 or 1,000 points out of a trade unless price action and technical analysis tells us we can get it. We are taking the most probable outcome and avoiding the least probable outcome. Make sense?
Mm-hmm.
Yes.
Okay. So there's my wrap on EMAs and why we use them. Okay. It's a fast way to see your bias. It's another confluence you can add to your trade. Just know that they are lagging indicators, and the 500 and the 1,000 day carry a lot more power than the 500 than the 50 or the 200 day. And those are the likely places you are going to see your Fortune 500 companies entering trades. That is where you're going to see Citadel, BlackRock, JP Morgan, Chase, all the big guys are going to be entering on those levels. So you will find you don't spend a whole lot of time below them unless that is the overall intended direction. Okay? So, moving on to one last thing that I use on my chart. And this is probably the most powerful thing. And I'm going to shut every other thing off. Actually, you know what? I'm not going to do that. We're going to just open a different chart. Let's see, which one did I have? Here we go. Okay. So now this is a little bit more confusing and a lot more technical. Right? This is called VWAP. And when we're using VWAP, we're paying attention to the one main level in the middle, that yellow line. And it can be different for everybody because it depends on how you set it, right? You can set that level to be any color you want. But on a normal chart, when I'm trading, see VWAP here is my yellow level. See where price flattens out? And I don't have all the other bands marked out like I do on that chart. Okay, these are bands. So these are deviation channels. And what I'm pointing out are these guys right here. See the line here, line here, line here, line here, and then you have your extremes here and here. Okay? So we need to think about these as support and resistance, right? And our support is going to be here at the bottom. So this would be -1, or excuse me, -3. I'm not even going to try and write that out. It never works very well for me. Just know that this would be your deepest level of support. This is your intraday level of support. And this is your closest support. And the price is always going to want to trade between these three bands back to the middle. So let's call this guy our middle, right? Anything below is a discount. Anything above is a premium. Do we see that? So if you buy below this level, that means you are getting it cheaper than anybody that bought at or above. Okay? And if you want to go long, you want the best discount price you can get. And when you understand standard deviations of VWAP, you understand that price very seldom lives outside of 2 deviations from VWAP. So these 2 channels right here underneath, right? Very seldomly will you get any lower than that second channel. And if you do, that means there is high volume. There is an extreme amount of volume selling to the downside, which puts you into the extreme band or 3rd deviation of VWAP. If you go back and look, you will learn very fast. These are the areas you look for to buy to go long, because price does not live in these bands very long. Make sense? Same thing applies up here.
Yes.
When price is most happy between VWAP and the 1st deviation, or the 1st deviation and the 2nd deviation. So when you get near the bottom of the 2nd deviation, if you get confirmation or confluence that says you should be entering long, this is a good place to look. It is not a guaranteed entry. You need to understand the structure. You need to look at the context and the conversation price action is telling you and say, okay, does this make sense to take a long here? And we do that by looking left. Now, anybody see what we're really close to hitting on this chart?
Our trend
Trend
line.
Right. Where does that trend line line up with the deviation? Pretty close.
In
Right?
our second and third, yeah.
Right. Now, the third and final thing that this deviation is telling you that is most critical is that it is highly, highly unlikely for price to live here and price to live here. So it is telling you that this from here to here is your trading range.
Mhm.
Okay? So as time moves on and price and volatility step in, these bands get wider, right? And we can see that if we go back and look at a prior day, right? So what this is telling you is that price cannot live below here and it cannot live above here. And what's the one thing you don't see happen? You don't see price get anywhere near either one of them. Where does price live? In that 1st and 2nd band, right? So when you hear or you come across somebody on TikTok that talks about trading VWAP, this is what they're talking about. Look what happens when you get into that 3rd band here, right? Do you see how it cannot get above it? It cannot live outside of it. VWAP has to move up with it in order to go higher. But if you shorted based on structure a rejection like this, look, you could have traded from the second band to the first band and got paid, what's that, 800 to 672, almost 230 points, just based on knowing where your price is on VWAP, right? So if I'm trading this market, I'm looking at this top band as it's printing, and every time I see price push up to it and does not continue, I'm looking for a short opportunity. And you can see down here, we took quite a few trades off of this the other day. Let me get this to zoom in here. And this was using exactly that same thing I explained to you guys earlier about putting the trend line down, waiting for a break, waiting for a retest, right? Except for you're seeing my trend lines on a 5-minute chart that were placed on a 1-minute chart, so they don't really look anatomically correct. But always, always, always know that that yellow line, the price in the middle, VWAP, this line right here is where price is at what?
At its baseline?
Where
It's like
price
fairest value, right?
at fair value. You got it. That is where price is in neutral buoyancy, meaning there is no buyers and there is no sellers, and you need liquidity to move away from it. Otherwise, it acts like a magnet. And when you get a move that breaks one of these lower bands to the upside, you are going to go back to VWAP. Now, the way I trade this is very, very simple. Okay? I wait for a break and a retest of VWAP. Whether I'm trading long or short doesn't matter. If price breaks through VWAP and retests and hold, I am taking a long entry position, and my first target is going to be that first or second band. Okay, but I know my target's going to be in here because anywhere above that is highly unlikely. Make sense?
Mm-hmm.
Same thing below, right? Price breaks below.
Yeah.
I wait for the retest and I take it short to either that first or second band, because anything else is going to be highly unlikely. Any
Understood.
questions? How about you, Freddie? I know you were trying to catch in on this earlier in the week. Anybody else have any questions so far?
No, sir.
All right, very good. So with that being said, I think we've covered a lot, and I don't want to continue flooding you guys. I want you to let some of that absorb, right? So I think we just kind of finish the night out here and see if we can find some good trades that we can validate and practice with. Anybody objecting to
Awesome.
that?
No, sir. Sounds
Alright.
good.
No. You've given us a lot to work with.
Absolutely. And that's what the
And you said this was
TRC is all about.
Mm-hmm.